Silver market pummeled. Gold surges. COMEX closed for weekend. Silver didn't just fall, it was forced down. Gold didn't just rise, it was telling you something. And COMEX closed its doors right at that exact moment. 3 moves, 1 weekend. One question nobody is asking loudly enough. What if this wasn't a market event? What if this was a warning? The answer is already in the data. And what it reveals should change how you think about every dollar you own. Welcome to the boring currency, the one place on the internet that doesn't chase markets, it reads them. Now, before we go any further, if you have lived long enough to know that real wealth is never built with noise, do this channel one small favor. Press subscribe. The same way you'd water a plant you planted 30 years ago. Quietly, patiently, without rushing. 1 tap, that's all. And one more thing, drop a comment right now. Tell us what city, what country, what corner of this world are you watching from today? Because this story touches all of it. It was a Friday. Not the kind of Friday that ends quietly with markets drifting into the weekend on low volume and thin attention. It was the kind of Friday that serious investors remember for a long time. The date was April 3rd. The city was New York. And somewhere inside the world of gold and silver trading, something was already moving that most people would not fully understand until it was over. The mood entering that morning was not calm. Traders were watching their screens with the kind of focused silence that experienced market participants recognize immediately. Analysts were refreshing their data feeds. Risk managers were running numbers they had already run twice before breakfast. The atmosphere carried that specific weight that only appears when markets sense something coming, but cannot yet name what it is. There was pressure coming from multiple directions at once. Geopolitical tension was sitting at elevated levels. Inflation data had been sending mixed and uncomfortable signals for several weeks. The dollar was moving in ways that made currency desks nervous. And the bond market, which experienced economists have long called the smartest room in the financial building, was showing signs of stress that very few mainstream voices were discussing openly. Gold and silver were trading inside this environment. They were not moving in a vacuum. Every headline that crossed the wire, every speech that was scheduled, every number that was released added another layer of pressure to a market that was already carrying more weight than it appeared to be carrying on the surface. The metals were absorbing all of it, quietly, continuously. And then the hit came. Silver got pummeled. That is not a dramatic choice of words. That is simply what the price chart recorded with cold and precise accuracy. The drop was sharp. It was fast. It happened inside a window of time so specific and so clean that it immediately caught the attention of everyone who was watching with serious eyes. The kind of move that makes even experienced traders sit up straight and look twice at their screens. Gold was not spared either. It took its own blow. The direction was the same as silver, down, hard, fast. The severity was different, but the message on the chart was identical. Something had entered the market with force, and it had moved both metals in the same direction within the same compressed window of time. That kind of synchronized movement does not go unnoticed by serious analysts. 2 types of people responded to what they were seeing on their screens. The first type felt the drop in their stomach. They saw the red numbers. They started asking emotional questions and reaching for explanations that felt satisfying rather than explanations that were accurate. They were reacting. The second type did something entirely different. They slowed down. They looked at the data more carefully. They asked better questions. The better question was never who caused this. The better question was what this move actually meant. Because markets do not move without reason, even when the reason is not immediately visible to everyone watching. Behind every sharp move, there is a set of forces. Some visible, some mechanical. Some deeply connected to decisions made in boardrooms and trading desks that most ordinary investors never see and rarely think about. And then there was the other detail. The one that changed the entire context of everything that was happening on that Friday afternoon. COMEX was closing for the weekend. No trading, no price discovery, no ability for any investor anywhere in the world to respond to breaking news for 2 full days. That single fact, sitting at the end of an already tense Friday, turned a significant market move into something that felt far larger than it may have actually been. The surface looked alarming. But beneath the surface, the real story was still forming. And reading that story correctly would require something that most people watching their screens that afternoon had already lost: patience. Most people watched the drop and saw a disaster. They saw red numbers, falling charts, and a market that appeared to be breaking apart at the seams. But there was another group of people watching that exact same screen, seeing that exact same data, and arriving at a completely different conclusion. These were not lucky people. They were not smarter by accident. They were simply asking a different question. Not what fell, but why. The first force operating inside that Friday move was one that almost never makes headlines because it carries no drama and attracts no audience. It was institutional risk reduction. Large professional money managers, the kind who oversee billions in capital across dozens of asset classes, operate inside a framework that most retail investors never fully appreciate. Their primary responsibility is not to chase returns. Their primary responsibility is to protect capital. And protection looks very different when a weekend is approaching. When a fund manager is sitting on a large position in silver or gold and the calendar says Friday and the geopolitical temperature is running as high as it was on April 3rd, the calculation becomes very straightforward. If something happens over those 2 days, a war escalation, a surprise central bank move, a major political announcement, there will be no market open to exit through. No price discovery, no emergency door, just silence and exposure. So the professional decision, the responsible decision, is to reduce before the close, quietly, systematically, without emotion. Now multiply that single decision across dozens of funds and hundreds of institutional trading desks, all operating inside the same risk framework and all looking at the same calendar. What emerges is not a conspiracy. What emerges is selling pressure. Significant, coordinated-looking, fast-moving selling pressure that has no villain behind it and no dramatic explanation beneath it. It is simply professionals doing what professionals do when the rules of risk management and the reality of the calendar arrive at the same moment. But institutional selling alone does not fully explain the speed and the sharpness of what happened to silver that afternoon. There was a second force in the room: short-term traders. These are entirely different animals from long-term fund managers. They do not think in quarters or years. They think in hours, sometimes in minutes. And their entire strategy depends on identifying crowded positions and leaning on them at exactly the right moment. Silver entering that Friday was a deeply crowded trade. A large number of market participants were positioned in the same direction, carrying the same thesis, sitting in the same corner of the room. And crowded trades have a specific and very predictable vulnerability. When a catalyst appears, whether that catalyst is a headline, a speech, or simply the sight of prices beginning to slip, the crowded side unwinds fast. One participant sells. The price dips. Another sees the dip and sells. The price dips further. And within minutes, what began as a small and orderly adjustment becomes something that looks catastrophic on a chart, even though the underlying reason is nothing more than a crowded room trying to exit through a single narrow door simultaneously. Then came the third force, the one that operated faster than any human being in that room could react to: algorithms. When a major political figure began speaking that Friday inside an environment already saturated with uncertainty, trading algorithms responded in milliseconds. These systems are not making judgment calls. They are executing programmed responses to specific language patterns, tones, and key phrases that trigger preset actions instantly. Words connected to tariffs, conflict, monetary policy, or economic instability do not wait for a human analyst to finish reading the headline before moving futures markets. They move first. The analysis comes after. Three separate forces then. Institutional risk reduction driven by the calendar. Crowded trade unwinding triggered by the first sign of weakness. An algorithmic response to political language operating at speeds no human decision can match. None of these forces were communicating with each other. None required a mastermind or a coordinated plan. They simply arrived at the same moment on the same Friday afternoon and produced a move that looked designed because it was sharp, fast, and perfectly timed. Understanding the mechanics of a market move is not an academic exercise. It is the difference between an investor who reacts and an investor who reads. The ones who reacted that Friday saw a crash. The ones who read it saw something else entirely. They saw a market under pressure revealing exactly how it was built and exactly where its real foundation sat. And what that foundation showed them next was the part of the story that truly mattered. There is a moment in every serious market event that separates the informed from the uninformed. It does not arrive with fanfare. It does not announce itself with breaking news alerts or loud voices on financial television. It arrives quietly, almost invisibly. And on that Friday afternoon, after silver had been pummeled and gold had taken its hit, that moment arrived precisely on schedule. The market moved again, but this time it moved in the opposite direction, and almost nobody was paying attention. The ones who missed it were still focused on the drop. They were still processing the red numbers, still calculating the damage, still searching for someone to blame or something to explain what had just happened to them. Their eyes were locked on the wound, and they never looked up long enough to see what the wound was actually revealing. Because beneath the surface of that sharp and painful drop, something was already pushing back, quietly, deliberately, with a kind of patience that only genuine conviction carries. Gold moved first. It began clawing back territory that the earlier selling pressure had stripped away. Not quickly, not dramatically, not in the kind of explosive recovery that fills headlines and generates excitement. It moved the way real strength always moves in markets. Steadily, methodically, one price level at a time, Each tick upward was a small but meaningful message being sent from the buyers who had waded through the chaos and then stepped in when others were still running toward the exit. Silver followed. It did not recover as cleanly or as completely as gold. The damage in silver had been deeper, and the crowded trade that had unwound so violently earlier in the session left marks on the chart that a single afternoon could not fully erase. But it came back. Partially. Stubbornly. In the way that a market comes back when the selling was mechanical rather than fundamental. When the force that drove the price down was about calendars and algorithms and crowded positions, rather than a genuine collapse in the underlying case for the metal. By the time the session was approaching its final minutes before the COMEX weekend closure, the chart told a story that was dramatically different from the one it had been telling 2 hours earlier. Gold futures closed just above 3,100. Silver futures closed just above 30. These were not the loose figures being thrown around carelessly in the loudest corners of financial social media that afternoon, where precision is often the first casualty of excitement. These were the actual numbers from the close, and placed on a weekly chart, they carried an entirely different weight than the intraday drama had suggested. The weekly candle told the real story. It showed a market that had absorbed institutional selling, algorithmic pressure, crowded trade unwinding, and the psychological burden of a long weekend closure all in a single session. It showed a market that had been hit hard from multiple directions simultaneously, and it showed a market that had refused to stay down. That specific combination, serious pressure absorbed and then partially reversed, is not something that appears in weak markets. It is the signature of a market with genuine demand sitting underneath the surface waiting for the selling to exhaust itself. The gold-silver ratio at the close settled in the mid-60s. This single number carries more strategic information than most casual observers realize. When the ratio is elevated, it means silver is historically cheap relative to gold. When it begins to compress, it has historically signaled that silver is preparing to outperform. Experienced precious metals analysts do not glance at this number casually. They place it carefully into their models because it speaks to relative value in a way that raw price movement alone cannot communicate. And a mid-60s reading, entering a weekend of maximum geopolitical uncertainty, was the kind of data point that serious capital allocation decisions are built around. But the rebound was never purely a technical story. Markets are not machines, even when they behave mechanically. They are built from human decisions, layered on top of programmed responses, layered on top of institutional frameworks. And when a market absorbs a serious blow and then refuses to surrender completely, it sends a psychological message to every participant watching. It says the buyers did not leave. It says the thesis that carried gold and silver higher through the weeks and months before, that Friday was not broken by one difficult afternoon. It says that whatever forced the price down was not strong enough to overcome what was holding it up. That distinction between forced down and fundamentally broken is the most important analytical judgment any serious investor can make in the immediate aftermath of a sharp market move. The ones who could not make that distinction on that Friday saw a defeat. The ones who made it correctly saw something far more valuable. They saw a foundation being tested and holding, and a foundation that holds under serious pressure does not just survive the test. It earns a new level of credibility that no calm market day could ever provide. The weekly candle closed, COMEX went dark, and the real question was already forming. History has a very specific way of delivering its most important lessons. It rarely arrives through grand announcements or obvious signals visible to everyone watching. It arrives dressed in ordinary events, wrapped inside a normal Friday afternoon, hidden beneath numbers that most people glance at and then scroll past without a second thought. April 3rd was exactly that kind of moment. And the 3 warnings it carried were not written for casual observers. They were written for serious people who understand that preparation is not a luxury. It is the only real advantage available in an uncertain world. The first warning was about liquidity, specifically about what happens to liquidity when a market closes its doors inside an environment that has not finished speaking. COMEX closing for the weekend is a routine event under normal circumstances. Markets close. They reopen. The world continues. But context transforms routine into risk faster than most decision makers appreciate. When COMEX closed on that Friday afternoon, it did not close on a calm and unremarkable week. It closed on a week carrying active geopolitical tension, unresolved inflation pressure, sovereign debt stress building in places most headlines were not covering, and a political speech that had just moved futures markets in real time. That closure created something professionals call a liquidity gap, a period of enforced silence in a conversation that was nowhere near finished. For 2 full days, every investor, every fund manager, every institution with exposure to gold and silver sat with positions they could not adjust, risks they could not hedge, and news they could not trade against. The world does not pause because COMEX is closed. Governments still make decisions. Central banks still send signals. Geopolitical situations still develop. And when Monday morning arrives and the doors reopen, the market reprices everything that happened over the weekend in a single violent instant. The lesson for every serious decision maker is precise and non-negotiable. In high-risk environments, the calendar is not a scheduling tool. It is a risk variable. The professionals who reduced their exposure before that Friday close were not being timid. They were being disciplined. They understood that the cost of being wrong while the market is open is manageable. The cost of being wrong while the market is closed can be catastrophic. Every business person, every entrepreneur, every young professional building serious capital needs to internalize this distinction before the market teaches it to them directly. The second warning was about data, specifically about what happens to decision-making when imprecise numbers enter an emotionally charged environment. On that Friday, figures were being shared across financial communities with a casualness that would be alarming to anyone who understands how capital decisions are actually made. Price levels were cited without verification. Ratios were quoted from memory rather than from source. And once those slightly wrong numbers entered the conversation, they shaped the interpretations that followed in ways that produced significantly wrong conclusions. Slightly wrong data in a calm environment produces minor errors. Slightly wrong data in an emotional environment produces catastrophic ones. This is not a problem unique to retail investors or inexperienced market participants. It exists at every level of the financial world. But it is especially dangerous for young entrepreneurs and aspiring business people who are still constructing their analytical frameworks and who have not yet developed the instinct to verify before concluding. The discipline of checking a number before citing it is not perfectionism. It is the most basic form of professional protection available. In markets, as in business, precision is not a preference. It is a survival requirement. The third warning was the largest one, the one that required stepping back from the specific events of that Friday and looking at the architecture of the world in which those events occurred. Gold and silver do not move in isolation. They never have. They are connected to everything that matters in the global financial system. They respond to currency pressure. They respond to central bank credibility. They respond to the confidence that serious people have or do not have in paper systems and institutional promises. And what they were reflecting on that Friday was a system operating under genuine and increasing stress. Inflation has not been resolved as cleanly as official narratives suggest. Debt levels in major economies have reached points that serious economists describe with language that is growing increasingly urgent. Geopolitical alignments that provided decades of stability are shifting in ways that carry real and lasting consequences for trade, currency, and capital flows. And the dollar, which sits at the absolute center of the global financial architecture, is facing questions about its long-term role that were not being asked openly even 5 years ago. These are not fringe concerns. They are the background conditions against which every serious business decision is now being made. The metals market did not create these conditions. It simply reflected them with the kind of honesty that official economic commentary rarely delivers. Silver was pummeled, gold surged, COMEX closed its doors. And beneath those three headlines sat a warning that every serious investor, every aspiring entrepreneur, and every young professional with something real to build and something real to protect needed to hear clearly. The weekend is over. Monday has arrived. The market is reopened with every question from that Friday still unanswered, still active, and still demanding the full attention of everyone who understands what is actually at stake. The ones who prepared are already positioned. The ones who were distracted by the noise are already behind. And in the world of serious capital, that gap between prepared and unprepared is exactly where financial futures are decided.